Welcome back to Give Me Some Truth. Syl and I are in the booth. We're going to have some economic commentary, but before then, a little bit new backdrop today. You're going to be seeing more of this. We're pretty excited about the unveil of the new podcast room, of which there's been a lot of toiling around, and you're going to see some different angles going forward, and we're super excited about, I don't know, a little bit of a relaunch.
Yeah,
a little refresh going on here. You're going to also have the opportunity to check out a new relaunch and refresh of our website and content that we're going to be pumping out here too. One of the things that we're also going to do today is try to keep things concise and give you some more bullet point items on how the markets are doing right now, and a little bit of prognostication from our chief prognostication officer, Syl here.
New title.
I know, right?
I like it.
CPO. I like it. So actually, we try not to give a lot of prognostication, but we'll call it observations.
Sure.
I think it's the best way to put it. So currently kind of, as we stand right now, ending up end of July here at this recording, we're looking at a market that's sold off slightly in the last week, but I mean, overall, strong market to start the year. Beginning of the year, you were pretty bullish still. So, I was surprised to see how well it's done, I guess, as being a consumer sentiment skeptic.
Yeah, I mean, I was bullish at the beginning of the year. I was bullish at the beginning of the previous year as well. I've been pretty consistently bullish about this market for a while. And, I think this year has been another good year. I would say, if you look at the second quarter, it's been a pretty strong quarter. At the same time, it's a lot of the same old in terms of the lack of breadth in this rally, in the sense that, as you and I were discussing before, there's very, very few names, very, very few stocks that really have contributed to the strong market performance in the second quarter and really since the start of the year. So really, it's a story about NVIDIA, Meta, Amazon, and Google, and these four names are responsible for a lot of the market's performance and a big percentage of earnings growth as well. That's really where most of earnings growth is coming from, and I think that's not necessarily a super healthy sign. We'd like to see a market that has a little bit more breadth, but this is the situation we're in now. Some people have called it the Magnificent Seven. But it's not even really the Magnificent Seven anymore, because it's really down to four stocks that are really driving this market.
Yeah, I saw that. I was looking at the Mag 7 share of return, 61% year to date as of June 30th. That's just incredible. And the S&P 500 return, when we take away the Mag 7, only 5% rate of return over that period of time. The share of return is only 39%. We're talking about 493 stocks contributing that small a rate of return.
It's pretty incredible. And, if you look at the S&P 500 in the last quarter, it's had, I think, a little more than 4% positive returns on a market cap weighted, so the index as a whole. But if you take the index and assign an equal weight to every stock, so what's known as the equally weighted S&P 500, returns were actually negative in the second quarter. So really, again, this market is working really well for a very small subset of the index, and it's just a very shallow market.
I think where that really is bad is probably for active management, unless they've loaded up on those stocks, right? It'd be very difficult to beat the index in this environment.
You really would have needed to be a tech-obsessed manager. Anything else would have led you to struggle.
Yeah, and I think that's what we see when we talk about rates of return on certain other sectors or people that get more specific in their managers. They just are wondering why are they not getting that performance.
It's tough, and even if because the rally is so narrow, even if you're into tech, if you bet on Tesla instead of NVIDIA, well, you were underperformed as well, right? So it's just even if you're into growth, you had to pick the right growth, and that was really a small subset of the market in tech and communication services. And that's really it.
So we've had sunny Syl for the past, year and a half or so. Are you feeling pretty sunny right now, or have you turned to sad Syl?
Well,
or skeptical Syl?
I think this market's going up, right? I think in the short term, there is really strong earnings momentum, and I think we're going to continue to have really strong performance. I think this market loves the whole easy money, lower interest rate narrative, and it looks like the Federal Reserve is getting ready to cut rates at least once between now and year end. My feeling is we see a rate cut in September. Maybe we see another one in December. And I think that's going to be very well received by the market. I think it might lead to a weakening of the dollar, which I think is also going to be very supportive to risk assets. So I like this market a lot. I also think that even though there's areas of the market that are looking very, very expensive, there's still a lot of good value assets that you can buy, right? So even though tech is expensive, more value-oriented sectors are pretty cheap. International stocks are pretty cheap. Emerging markets are not trading at very high valuations. And actually, if you look at the second quarter, emerging market stocks have done well. They've actually done better than the S&P 500. So I think there's still a lot of stuff that investors can get excited about. So I think that is going to lead to higher prices in the coming weeks and months. Now, I think, like you said earlier, we're not prognosticators, but we're observers. And I think as an observer of the market, and when you've seen the market do well for an extended period of time, with a few hiccups along the way, I think at some point you have to start asking yourself, are we late in this particular cycle? And I think if you wanted to kind of paint the picture of a late stage of the cycle, you'd look for things like a steepening yield curve after a long period of inversion, which is pretty much exactly what we're seeing right now. You would look for maybe signs of weakness with the consumer, and I think you're kind of seeing hints of that right now. You would look for weakness in the job market after a long period of full employment. And we've had a very long stretch of several years of a really, really strong job market, and I've written a lot about it. And I think you're now just starting to see unemployment rates tick up a little bit. And I think you'd look also for fairly elevated equity valuations, and I think you're seeing all of that. So you are ticking all these boxes as you go along. I think the last thing that maybe you would want to see would be like a blow off top kind of market dynamic, like a really
just running fast
and hard and crazy. And you'd want to see that being supported by some sort of theme or narrative that would explain why all the old rules no longer apply, and you're just stupid if you're not buying stocks, right? And I don't think I think we have that theme with AI. I just don't think we've seen the blow off top yet. We've seen strong market performance, but it's been pretty orderly. And I'm not seeing madness just yet. But I think if you wanted to look for signs of a reversal, you'd have your checklist, and you'd be ticking a lot of boxes right now. There might be a few more to go, and that's what I'm very focused on going forward. Again, things could change. Just because you ticked a lot of the boxes doesn't mean you can be 100% confident. But to your point about, as we were discussing earlier, that you've been kind of skeptical and a little bit cautious, and I've been more bullish. I would say I am, more skeptical now than I have been in the last couple of years.
So still sunny Syl, but maybe throwing a little bit of shade out there. So there you go. A little bit. I tend to agree with what you have. I've been a lot more skeptical as you have. And, I really do think that, there's a lot to like in this market and to continue to be optimistic about. But, I do see the consumer getting a little bit more tapped out now. We still have inflation still exists, although it's looking pretty good right now. And, we will see a little bit more of that interest rate abatement soon. And, hopefully that follows through to some long-term rates too. And we see a little bit with some advantage to real estate perhaps. And then the weakening dollar, I do think that maybe the sun will actually shine international assets, as we say every single year, and never seems to pan out. So, hopefully we'll see that eventually. And I do believe we'll see a weaker dollar, as you're indicating, especially as we cut rates. So, well, thank you for joining us on this market outlook, a little bit more on the second half. We'll be writing more content related to this, I'm sure, in the coming weeks. And thank you for joining us on another episode of Give Me Some Truth.
Walkner Condon Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Walkner Condon Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Thanks for listening, and for further information, please visit WalknerCondon.com.